Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. It's Quincy Krosby. This is The Talking Point. It's Monday morning, November 6th, and the pre-open for the market is positive. This is following a monster week for the market last week. You know, sometimes when you take a look at markets, and you take a look at, the negativity in a market that, it looks as if it never wants to go up. We have been saying over and over again that sometimes the more contrarian the market is, the more the market says, no, forget about seasonality. Things are so terrible that, that it's never going to kick in. Keep in mind, again, that November, December are probably one of the most hospitable periods for the equity markets. And that was the theme, by the way, coming into this year. Oh, everything is going to be great. Everything is going to be great. And until it wasn't, until the market saw the 10-year Treasury yield climbing higher and higher, the market was, there's no way this is going to be great. The more you get that negativity in the market, the more the market turns around and says, oh, really? You watch this carefully. I always liken sometimes the market to Mother Nature. Just when you think everything is going one way, Mother Nature comes in and says, oh, really? So again, it's the way the market operates. There's an old saying in the market that the market really, really doesn't like tremendous consensus estimates on anything, because then the market will say, oh, okay, that's what you're thinking. Let's move the other way. It is not, obviously, it's not all in fact, but there's a certain element in the market that, how shall I say, likes to see contrarian. You've heard the term contrarian estimates, the contrarian in the market. Well, obviously, there was a catalyst. We can't say it happened just out of the blue. The catalyst started with the Treasury Department announcement. And I think I mentioned it in the call from last week that we were paying very close attention to that because there were rumors in the market that the Treasury Department was going to have a slightly lower announcement regarding funding needs. In other words, borrowing. Remember what the Treasury Department does? It sells American bonds. And that, if it becomes too strong, more than expectations, the market gets very nervous because the question then is, okay, this is an awful lot of supply. How is it going to wind up in the actual auction? Will there be enough buyers coming in to bring the yield down? Remember, when the yield comes down, the price goes up. And so that has been a concern for the market. And what that rumor was that the Treasury Department was going to announce a lower number, still high, by the way, lower number for supply, but that was attractive for the market. And that meant, too, that the areas of most concern, which is the 10-year auction and the 30-year auction, that would have, again, lower supply. And also, just to not make it too complicated in this Monday morning, is that we'll start then to see shorter duration, short-term notes coming to market, which have been actually quite successful in the auction. So this is why that was important. And what that in turn did was push and push and push the markets looking at everything and saying, well, if the yields are going to come down, they ought to be coming down now. And that actually helped the positive move in the market. And you saw those Treasury yields come down, and they came down markedly. So that was important for the market. I mean, a market that is obsessed every minute of the day on that 10-year Treasury yield, when those yields start coming down, this is a market that said, whoa, something has changed. And that was those Treasury yields. Now, many people will say, well, it was the Federal Reserve being much more dovish. That may be adding to it, but the fact of the matter is when we look at the charts, the trigger was the Treasury auction announcement. That said, in terms of the Federal Reserve, the market has been, how do I say this, interpreting Chairman Powell's comments when they're dovish for some time now. I mean, you go back 5 meetings, and there was enough people in the market who were, practitioners markets suggesting that the worst was over, the Fed was finished. So right now, the market is basically saying, let's see more data, just as the Fed remains data dependent. But if there is a concern, and I say if there is a concern, yes, inflation is coming down, but the worry is, and that's if this keeps up, is that prices are still too high. And then when you have more sluggish growth and prices are high, you have a form of stagflation. Now, no one is suggesting that this is going to be the stagflation of the 1970s. That was extreme. But what there are concerns that the economy is slowing down, but are prices slowing down at the same time? And by the way, will the Fed have enough patience to stay on hold, waiting to see if prices can come down? The expectations are that the slower the economy, the slower the labor market, the slower consumer spending, that prices come down. And they come down because people aren't paying the companies. Again, the question is, how much patience does the Fed have for that? So we're going to have a sense of it, and I'll tell you why. Because this week, oh my goodness, Fedspeak on a roll, including Chairman Powell speaking. And if there's a Q&A involved, I'm sure he's going to be asked a couple of questions. But this week we will have a full range of speakers. The Hawks and the Dubs will get their turn to take a minute to explain their positions as to what the Fed may need. Now, also keep in mind that this week, in addition to all the Fed speakers, we are going to have a series of economic reports. It will not be dramatic. This is a kind of a slowish week. But this is Monday, November 6th. We're going to get the Federal Reserve Senior Loan Officers Survey. I like this report because what it is these are loan officers across the country, and they will say, what are they seeing? They're going to talk about, in essence, borrowing. Who's borrowing? Is there a slowdown in loan origination? It's going to be important because that has been an issue, has it not? But nonetheless, the question is, will it capture the fact that the rates are a bit lower? Because remember, this survey was created for October. So that means it's before the rates started to come down. But nonetheless, I think it's going to be interesting. It'll come out today on Monday, November 6th at 2:00. And as I said, the Fedspeak this week, you just go on and on about it. One other thing that we're going to be looking at, too, is the initial jobless claims that obviously come out every Thursday morning at 8:30. Now, they have been rising a bit, but let's keep in mind something. The United Auto Workers the strike has been weighing on the payroll reports. It's been weighing on the manufacturing reports, which, by the way, have pulled back down. We need to see a normalization as they go back to work on the effect that they've had on manufacturing orders and also on the unemployment number. So that's going to be important. But Friday morning is something that I'm going to pay attention to, and the Federal Reserve is going to pay attention to. And so anybody who follows the Fed is going to keep their eye on the consumer sentiment report. That this will be the preliminary report on Friday morning at 10:00. Before then, the next report will be the final report. What are we watching? We're going to watch, obviously, consumer sentiment, but embedded in that report is a picture of consumers' views of inflation. longer term inflation, 1 year, and then after that, even longer term. The reason I'm mentioning this is 1 year expectations on inflation have climbed markedly higher. This is something the Fed does not want to see. You will hear them talk about anchored and unanchored. They'll use those terms. When consumers say, well, we don't see inflation climbing much higher in a year or 3 years or 5 years, you would then say consumer expectations are anchored. But when they climb higher, those expectations climb higher, what happens is that central banks, not just the Fed, worries about that it becomes unanchored, and they do not want to see that. And the reason is that you start to psychologically kind of think about, well, everything is going to cost more in the future. Better buy it now. Everything is going to cost more in the future. Keep up buying. That, in essence, perpetuates inflation, does it not? So it's going to be extremely important when we see that. I am noticing in my travels that gasoline prices seem to have leveled off. But a report today suggests that the Saudi Arabia, remember, the de facto leader of OPEC plus Russia, still want to keep those production cuts in place. And maybe if those oil prices come down even more, perhaps cut a little bit deeper. They need to have oil prices high because for Saudi Arabia, they've got a very large budget and they are building cities for a post-crude oil universe. And the Russians need oil prices higher as well to fund their military campaign. So this is going to be important looking ahead. As far as the geopolitical concerns are, so far, again, it looks as if the Hamas-Israeli conflict is still contained in that region. That's what the market is focused on. And as I've said over and over again, it is the crude oil market that is completely focused on whether or not this expands deeper in the Middle East, in the oil-producing region, moving towards Iran. Because what will happen is we won't talk about crude oil prices inching higher. It'll be that they surge higher. And again, so far, that market is telling us that it doesn't see a movement away from the Gaza region and Israel. Also, we're going to pay attention to any discussion this week regarding the possibility of a government shutdown. So pretty soon, now that you have a leader in the House of Representatives, we're going to have to pay attention to discussions about whether or not they are in a position to cut the deficit a bit, or are they, in a position to say, well, if we have to, we'll shut down the government. This is going to be important for the market. But again, just in closing, there's an old saying in the market that buying begets buying and selling begets selling. And it's clear what happens. When a market is ignited for whatever reason, whatever the catalyst is, then you have short covering, which is normal. Short covering is actually the beginning of any bull market, right? It always starts that way. And then there was something called the gamma squeeze. Take a look at that, look it up, because that is where you have tremendous call buying, meaning, oh my goodness, I better get in right now. The market's moving higher and higher. Just look it up, what it means, because you may remember that term. Back in, I think it was June and July of 2021, when, you had AMC climbing higher and higher. And then one company that you had forgotten about, you didn't even know it still existed, climbing higher and higher. That caused that so-called gamma squeeze. And so it's where the sellers of the call options, meaning I think the price is going to go up for this stock or the whole market, they then have to cover it by buying that stock, and then that adds to the buying. So that is what the market has seen in this unbelievable push higher in the market. We have reached a level in the market. We have crossed for the S&P 500, 4,250, which was that important line. It's where the S&P 500 is above its 200-day moving average. Now the market is focused on for the S&P 500, 4,400. Keep an eye on that because that is seen as a resistance level. And we'll see if the market can continue to come in and push through that as opposed to just seeing that as a level it can't get above. The market's paying very close attention to this. In terms of earnings this week, pay attention to Uber Technologies and pay attention to Disney. I follow Disney very much because I see it as a bellwether for consumer spending. Now, I know they have other issues. They're unwinding parts of their media empire, but nonetheless, we want to hear what they say about visitors to their parks. You see the headlines in the U.S. of folks saying it's so expensive, it's so expensive. Well, let's see it in the data. So we'll see what they have to say. They're going to be important this week. Last week, Apple came in and, Apple doesn't typically offer guidance, but the analysts do, ask questions and through the forecast that they have, they sort of pick up, a kind of guidance. It sounds odd, but they don't offer a formal guidance, but nonetheless, there were concerns over their sales in China and so on, but it didn't stop the market. And keep that in mind. A market that wants to go up is going to go up. A market that wants to go down won't even listen to positive news. That is the irony of markets. And so we talk about markets that are oversold. Right now, technically, this market is short-term, not medium-term, but short-term overbought rather. Doesn't mean it can't keep going higher. Same way in selling. An oversold market can keep going down. Let's take a look and see how this market deals with the auctions this week, politics, geopolitical, and basically, any concerns that the market will have. But one test will be, again, to repeat, will be the auctions for the 10-year note, the auctions for the 30-year note that's coming up this week. And let's see if the market responds to what Uber has to say and what Disney has to say. But overall, it will be about Federal Reserve commentary, nonstop, 24/7. Have a very good week. We'll be back next week. Thank you all so very much. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.